Make sure it pop up on the tube. Oh, all right, we live. Make sure it pop up on the tube. Cool. What's good, everybody? So we got a few people tuned in. We live. Make sure it pop up on the tube. Cool. What's good, everybody? So we got a few people tuned in. We live. Make sure it pop up on the tube.
Got the lag.
Getting the playback.
Cool.
What's good, everybody? Yeah, I think it's late. We got a few people tuned in. Make sure it pop up on the All right, we should be good now.
All right, bet.
There. All right, sorry about that technical glitch. All right, we should be good now.
All right, bet.
There. Why am I still getting? All right, sorry about that technical glitch. All right, we should be good now.
All right, bet.
There. Why am I still getting? All right, sorry about that technical glitch. All right, we should be good now. I figured it out. I had a second YouTube link up. Yeah, I was like, yo, what's happening? All right, cool. What's good? We got mad people joining in. We got about 70 people already, so that is great. What's going on, everybody? So y'all know who I am. I am Zay, the host of First Generation Wealth Building. Had to get all that technical stuff together. This is the first time using this StreamYard to go live, but I'm super hyped tonight, y'all. We have a special guest. A lot of you are very, very familiar with this gentleman here, and we got some great questions. We're gonna dig in tonight. But for a second, what I'm gonna do is I'm going to turn it over and let Q, for those who may not be familiar with him, introduce himself and tell the people a little bit about yourself. Q.
I am a 10 or 11-year vet within private wealth management and investment banking. I currently sit on the institutional equity sales desk in equity capital markets within the corporate investment banking world. Yeah, man, I have a super non-traditional story. So my background is kind of wild. So I think we've talked on Clubhouse and different joints where people kind of got a chance to hear how I kind of bumped into this profession, which is dope and life-changing. So, it really fuels my passion for wanting to reach back and push forward. Because at the end of the day, that's what happened for me. And so a big part of this movement, right, is just being able to reach back and pull forward and help people out. So, it's a really brief introduction without getting into the details. I'm sure your questions will be flowing. So
yes. Cool, man. So what I wanted to do, and just for the people that are going to be watching, guys. So if you have not heard Q speak before, you guys know that he comes with a lot of institutional knowledge and has a lot of knowledge in investing. But one of the things that me and Q talked about is that for the culture, prior to getting into investing, one of the things that are very critical is your mindset and just money management skills. So on the first topic, and we actually got some questions, so I put this together, is that prior to we get into the investing questions, Q, can you tell the people a little bit about what was your journey before investing? So how did you go about changing your mindset? What kind of money management skills were important for you to begin your investing journey?
All right, so let's start at the beginning. In college, I was horrible with money. I had 2 cell phones. I used to have, jewelry, just waste money, go out, spend money, just didn't really understand it. Coming from a background where we kind of have an obsession with dollars, right? Like with paper, you don't really get the understanding of what money is and how to use money. So the first time you get it, you blow it. So I want to say I probably blew like 20 to 40 racks between college and the beginning of adulthood easily, just trying to keep up with the Joneses and just trying to do all the cool stuff. And as I got into my career and my environment changed, the people I was around changed, the conversations changed, and you start to learn that you're at a disadvantage because the people that are around me don't look like me. but their story as far as what they do with money, how they move is completely different than what I'm doing. And so it really raised like a red flag in my mind and go, okay, we're here, we're equals, we're peers. But outside of this, I need to figure out a way to catch up on everything I didn't get growing up exposure wise. Whereas some of these people were able to learn things from their parents, their neighbors, right? Just around them, their osmosis is learning things that us as a culture, we don't learn. And so
At
I
all.
had to dig deep into figuring out, okay, what's the basis, right? So the basis obviously is how you spend your money, where you spend your money, what you spend your money on. Like you can still have fun, but being able to budget. That was the first layer. Second layer I got into was credit, right? Credit, leverage. If you have credit, you have leverage because you always have a balance you can draw on for whatever, whether it's going to be for leisure or for investing, right? So, in the case in point, the market went crazy, right? And so at that time, if you had credit, you could take some risk in the down market and put some money to work because you had credit to leverage it, and you could work on a strategy where you could pay your bills at the end of the month by cashing out the market. But that only comes with leverage, right? But that's part of it. So I always say, like, you can't have a nice front yard, but your house have roaches because your money management, your balance, and then your credit needs to be stable for you to even get into investing. Because then, if not, you're going to be paying back money as you're making money, and that's no way to really do it.
Okay, so you said a couple of things that I want to tap into real quick. So you use the word budget. Now, in our culture, we don't like that B word, the budget word. So for the people out there who might be curious to know, do you still budget right now?
When I can. So I'm not going to front. Like for the most part, I'm able to. I don't have any debt, so for the most part, the first thing I did when I really got on was just erase my debt. Right, like I said, understand credit, how credit works. So if I got to pay a lot of debt, I try to budget. Obviously, I have to have fun and certain things, but I keep a mindful eye on how I spend my money. It's not like a super tight. Well, I'm only going to spend the amount of money. But I'm very mindful. Like I check Credit Karma, I check Experian, I check all my apps every day. First thing in the morning, I check everything to make sure everything's in set. And then I always have a mindful eye about how I'm going to do something, why I'm going to do it, right? And if I'm getting a new credit card, why am I getting that credit card? What's the benefit of it? And again, like I look at stuff like that because they're going to pay me to swipe my card. Right? They're going to pay you to do that, right? So that's another incentive when it comes to credit and budgeting. Like if I know what I spend my money on, so I know I'm going to spend say $500 a month on groceries, right? I get a card that akins itself to groceries because then I'm going to get money back for doing what I'm supposed to do, not taking the card and buying something that I normally couldn't afford, but like taking these cards and using them for points and then cashing the points out either for vacation, for money, for gift cards, for different things. So I budget. It's not as hardcore as it used to be. I'm still, we all struggle with different things. It's still a struggling thing for me. It's not like a hardcore. I'm better at it, right? But right now, I'm doing okay.
Nah, that's good because one of the things that you said, and I've noticed this as far as my wife and I's journey, as we're pretty close to being debt free, but I've noticed that as we paid off more and more debt, we got a little lax with budgeting per se because it's like we don't need to be so tight because it's like we don't need to account for all these extra bills or all these extra liabilities. So I think what you said is key. I would also want to dig into just one other thing before we transition, or two things actually. So number one is when you were paying off your debt, what method did you use? And then number two, well, let's answer that question. Then we'll get into a little bit more of the credit leverage because I know you're a credit card aficionado. So I definitely want to. I want to get into that a little bit more.
What I realized was once I dug in, you realize what your credit is comprised of. So 35% of your credit score is based on your payments. So if you have a good payment history, but there's a way to artificially kind of create more payments. So when I first did it, I would pay like everything down, like I can on one card, right? Get my utilization. So 30% is your utilization of what you're using. So I attacked it card by card, right? Because at the end of the day, if I had like say $11,000 in credit, unless I got a lump sum of money, like I'm going to attack it card by card and knock it down, right? And that's the best way I think I could do it. Now, when I do get a lump sum, whether it's like a tax return or a bonus like that, then I can hit everything and knock it out. But in the interim of that, I usually attack at the card, right? I attack the card with the highest interest rate. So if you look at your interest rates and you say, okay, well, this card 29%, this one's 24, lesser of two evils, you gotta pay interest regardless. I'm gonna knock the higher joint down because I'm gonna pay less interest with the higher joint, and I'm gonna go on and on and on. So that was my first thing. Like I said, and keeping a tight budget of saying, all right, I'm gonna spend this amount of money. I know exactly, like there's apps, like the Mint app is a good app to use. That lets you know like where your money is going, because a lot of times we do make frivolous purchases. We're all guilty of it. Like no matter how much money you make, how much money you have. So that kind of track really helped me track down my my debt to the point where I don't have any credit card debt at all.
So it sounds like you kind of went and so for the people who might not know, it sounds like you used the avalanche method, where you started with the higher interest first, because for people who may not know and are watching this, if you start with your higher interest first, you tip in the long run, you're going to save money. Now, me on the other hand, we did the snowball method. We just went and lined ours up by lowest amount because we just wanted the quick wins. Like it was just that mental, you know, just that mental of like, yes, one day I don't gotta, you know, I don't have to worry about them on my back. That's just one less creditor. And then that snowball effect just starts to pile up. So for people who aren't familiar with either, though you can use either method. I think you just have to look at in your situation and really, you know, decide on what you want. I know a lot of people who use hybrid methods. I know that's what we did. You know, we used the hybrid method. Even though we did snowball, we also was like, all right, well, let's focus on the one that has the higher interest first. And so we knocked out a lot of debt that way. So that's cool.
A game you can get into, but it's not for everybody. Is the balance transfer game. That's another game I don't really rock with that, but that works too. Like, listen, you gotta pay a little fee, but you get 0% for 12 or 18 months. Like if you are in that kind of debt where like you're at those levels where like you have to make payments and you're there, that's not a bad option to look at, just because again, you buy yourself 15, 12 months of no interest and you're able to knock in the balance, but that's like for another day.
I even forgot about that method. You're right. And then your credit got to be okay for you even to get approved for that balance transfer.
Like you have to finesse it a certain way. There's ways around it. Like, you know, millennials, like I said, I always tell people, millennials, we use credit, we bank different. So there's definitely ways around it. It's just you have to do your homework, and it has to be something that fits what your plan is, what you want to do as far as your credit stuff. Because again, it's your credit score. It's not my credit score. It's not yours. It's your own. So you have to do what you're comfortable with. But that's a strategy people can use. If you have a decent credit score and maybe you're facing some debt, and it's a way to kind of get off of the interest rate, you're going to pay a fee still, but the fee is going to be a lot less than what you pay over time if you're paying that large 25%, 24% a month.
And then I got one last one because I had somebody actually ask this question, so I'd like to get your take on it as well. What are your thoughts on consolidation? So say a person has, you know, 4 or 5 credit cards, all of them high interest, and they say, you know what, I want to consolidate this just to make one payment. What would you say to somebody that is in that predicament?
If the interest makes sense, do it. Sometimes it's not going to make sense because these are
so yes, typically.
If everything actually benefit, you do it. But that's a mathematical equation, because you have to realize what you're going to be spending as opposed to what that lump sum is going to bring on a monthly basis. So, like, I don't know, it's all right. It's all based on your credit. So they say, yo, it's 10%, but the fees, you know, realistically make it 20%. You might be cutting here and there as far as what you're saving in money if you're paying 24%. The 4% is not going to kill you, you know, so.
I think it said, some people said it was a little echo. Never mind. They said it's gone. So can you repeat what you just said? It said your audio was cutting in and out.
Is it me?
Yeah, they said it was going in and out. It was a little choppy, but now you're good.
No, what I was saying was it depends on the actual like interest rate, what you get from the lender. Because the lender can be kind of predatory when you think about it, because they'll send you some joint like SoFi or somebody else will send you like, oh, let's consolidate. It sounds great, but again, there's loan origination fees. There's a whole bunch of other stuff that goes into that loan. So when you see 6%, a lot of times it's not just 6%. It's something else that goes with it. So being key to what the actual package is as a whole, and then doing the math. It's all personal, right? That's why it's personal credit.
Yep. Yep. No, I agree. So I just wanted to get your take on it because I know some people, they have that thought of I should just consolidate because they think one payment is going to be easier. But like you said, you got to think about the origination fee. You got to think about, could you have, and here's another gem. Sometimes if you're in that situation, you can call your creditors and work out plans with them to where you don't need to consolidate and they'll accept smaller payments, and sometimes they'll even write off some of what you owe them if you let them know that you're in a financial hardship. So definitely go ahead and somebody said check my mic. Is it good?
It's a little choppy.
It was choppy. All right, is that better now?
Nah, it's still a little staticky. I don't know if you got your elbow on it.
No, let me turn it down.
You got the Swiss Beast microphone.
I know I had to get the new mic, man. Is that better?
Nah, you sound like T-Pain.
I sound like T-Pain. Still sounding like T-Pain.
Yeah, it's like raspy, like the raspy on your joint. I don't know what happened to it.
Oh man. Give me a second. All right, we should be back. How's that?
Still a little raspy. Nothing in front. I wouldn't say you're wrong.
I'm gonna try and turn it up. See if does that work better if I turn it up?
Nah, it's still wild chops.
Come on, man. All right, we're gonna get this together. Is it still choppy, or let me know if it comes through?
Yep. Go ahead, try it now.
All right, I'm gonna unplug it. Let me unplug it. How's that?
Still a little like background noise on it.
It's a little
like a little talking. I don't know. I got the speaker all the way up, but it's double or something.
That's what I think it is. Let me turn this down. How's that?
A little better, but still
better.
It's not crispy as it was before.
All right, it'll probably come back. Hopefully it'll come back. Shit, I paid good money for this mic.
So you might talk to Sam Ash.
I know, right? All right. Hopefully, can y'all hear me? Is it better, or is it just gonna be clearing?
Can I hear you?
Yeah, can you hear me?
I can hear you.
All right. Hopefully that's better. If not, I'm gonna keep messing with it and get better. All right, sorry for that brief interruption. So let's get into entering the market. So that was the next topic. They said it's bad. All right, let me just unplug it. I'm gonna just have to use my loud. All right, how's that? How's that sound?
Better. Yeah,
a lot better?
Yeah, you good cash.
All right, there we go. I'm gonna just have to unplug the mic and check my mic later. Okay, so let's get into entering the market. So we talked a little bit about just money management skills, as well as important to change your mindset. So when you're going into the market, some of the questions that we had was around like how do you do your research and fundamentals. But before we get into that, one of the questions that I think is really, really important is setting your goals and having a plan. So can you talk a little bit about what is it like when you set your investment goals and your trading plan?
So like you mean like now, or you mean when I first got in the market?
When you first got in.
I think when I first got in the market, it was a little less intimidating because I worked around it. So working in that form where you're talking about it every day, it becomes more of a natural conversation. So you become less fearful because you're around it and you see it, it's tangible, you can touch it, you can feel it to a certain extent. So for me, I always understood that like premium companies win when you begin. Because again, in life, like we're fighting for options, right? And the option that we fight for is time. That's the currency that we fight for. We're not fighting for anything else. Because all money does is bring you more time, family time, free time, vacation time, right? It just everything's attached to time. That's what money brings you. Yep. And so premium companies allow you more time to do research and get better while you can make money.
Okay.
So when you start looking at your bank account and go, okay, I have 25 racks in the bank, let's just say, and I want to let it sit there because I like checking in my app and looking at 25 racks. Well, inflation is 4%, sometimes depending on the rates are 4, 5, 7%. So that means you're losing 7% while your money's sitting in there. So you might as well put your money in a premium company, right? Like an Apple, Microsoft, and let it chill there. You'll make more money over the course of a year, but it also gives you time to learn the market and not to watch a stock, but to actually start to learn why you're making money. It feels good to make money. That's once your confidence is a little higher, but you actually get a chance in your investors. So you might pull the paper up and say, hey, what's Apple doing today?
Okay.
And I'm always a big proprietor of, if you learn one company, you're gonna accidentally learn a bunch of other companies because it's osmosis.
Yes.
Let's just say, for example, you say, Q, I got 20 racks and I bought McDonald's. And it's like, all right, well, you have to learn about McDonald's, right? And when you learn about McDonald's, you're gonna understand that they're not just a hamburger slinging company, they're a real estate company.
Right.
Ton of real estate. But then you have to understand their competitors, right? So the Wendy's, the Darden food groups, the Chipotle's. So now you've learned 5 or 6 other companies and what they do, because they're all in competition with each other. So now I've learned 5 companies, right? But now, okay, so I've learned real estate, right? I've learned about the competitors. So I've learned 5 companies, learning 1. Then when I look at the fact that they have to ship these goods around the country, somebody has to bring them burger patties and that bread on truck. Now I learned trucking.
Okay.
Now shipping. Now I learned UPS and FedEx. So through osmosis, I've learned about 10 companies while my money was making money with McDonald's. And that's what I learned when I first started. I said, not to chase the next best thing. We have a bad habit of saying, oh, that stock went from 16 to 70. Let me buy that because that's a smart idea.
So I'm glad you said that, right? Because that was the segue that I wanted to get into. How were you when you was first getting in? How did you manage to stay away from the penny stocks and from all the hype stocks? Because I do tend to see that, like when our culture, when we first jump in to the game, we typically want to go for what's hot or what's cheap.
Yep.
It's like we have this dream of turning $500 into $100,000. Like, so can you talk a little bit about how you were able to avoid those kind of pitfalls for somebody new that might be just entering the market?
I mean, 2 thought process.
Comments are hilarious.
The first process, right, is that, like, for me, when I started doing this is a legacy thing. This isn't just a I want to get rich scheme, right? And building a legacy is not a get rich quick scheme. It's a long-term thing that is bigger than yourself, and most of the time you're not going to see the proceeds of your work. It's being left with somebody else. That was my first thought process. But second, it goes back to your time. If I have a penny stock, I have to watch the penny stock. If I buy a risky stock or anything, I have to watch it. So now, let's say I do make money. Let's say the best thing ever happens, I make money. I don't have a plan for the money that I've made. So now I have to waste time figuring out where to put the money. And that in itself is a waste of time, and we can't get that back. I can get that money on a bad trade. If I make a bad trade, lose bread, I can always get the bread back. I can't get the time back. And so, like I said, the premium companies that make sense, that aren't going out of business, that have great balance sheets, that have wonderful CEOs, that have a rich history of making money, it's right in front of you. So it allows me, again, time, because now I can learn about the company. So I was never into penny stocks. I was never into swing trading. I was never into day trading. I want to invest long term. When you do those trades, not that you can't make money, but that's speed dating. When you long term invest, that's a relationship. You get to really know the company and the management and what they do, and that's how you make real money over the course of time. You can get lucky. The worst thing for somebody to do is get lucky on an options trade or get lucky swing trading. Their first 2 or 3 times, now they're a genius. They've made all the money, and they don't understand the market. They have no base to their there's no foundation to their base, right? And all it takes is one choppy market or a downtrend for them to lose everything they got.
Right.
And so understanding that, I wanted to make sure that my base was as stable as possible. That's my foundation to my home. The foundation to my legacy is as stable as possible. That I understand everything that I'm getting myself into when I go into a company. Not, Zay bought Facebook, so I'm gonna buy Facebook. I never want to get rich off of somebody else's homework. That's no way to learn. So if you spend your whole time copying somebody else's homework, what happens when they graduate?
Yeah, you stuck now. You ain't got nobody to cheat off. But that's I love that you put it that way, because I mean, right now with the whole movement, and you're part of it as well, and you talk to Mark and stuff, and it's just funny because we get a lot of people who ask about, like, what should I do with this move, and it's like you can kind of tell that they're just following out, doing that research, and like you said, getting rich off somebody else. So it's very key that you do your own research, your own due diligence. So it's big that you said that. Now I want to kind of segue, because you also said something that you build your foundation first, and it's investing, and it's something we actually talked about. So for the people who might be a little confused, right? Can you explain the difference between investing and trading?
Okay.
Because a lot of people, when they first jump in, they're like, "Oh, I want to trade. I want to trade."
Yeah.
And they kind of make that almost synonymous with investing, but it's really not the same. So can you kind of break that down for the people?
So when you're trading, you may not be trading on fundamental information. You might be trading on technicals. You might be trading on quants. You might be trading on news, right? You're looking to make money. You're looking for an opportunity for you to buy the stock at one point and then sell it right away. And so that game is very addictive. Why? Because you could be right. You could buy a stock at 9.35 and sell it at 9.40 and make some bread.
Right.
And that's not investment because you know nothing about the company. You know nothing about the management. You know nothing about the business line. You know nothing about the future plans.
Right.
Investing is planting your flag. So when you look at a company, you go, okay, I see the value. I like the management strategy. I believe in management strategy to be able to put the plan in place and execute. I believe in 5 years they're going to be here and you're going to go along for that ride. So it's not I'm going to check it every day and be nervous ride. It's I'm going to come back in 5 years and I know I'm going to have more money than I put it in the account kind of vibe, right? And so that's what investing is really getting to understand and know the business, to understand the growth of the business. So, when some of these companies make money and people are like marvel, oh my God, I didn't see that coming. It's like, no, it was there.
Right.
They told you. Like if you listen to the earnings call, they told you what they want to do. If you read the reports, they told you this is our plan. And so it's one thing for a company to lay out a plan. It's another thing for them to execute it. And it's a third thing for you to believe that they're going to do it, right? So I always like this, right? I could tell you, I'm going to beat LeBron James in basketball. And you go, you lost your mind. And I can lay out a plan. I'll see this. I'm going to do this. He's like, that's actually a good plan.
Right.
But you don't actually believe I'm going to beat Bron in ball. You're still going to bet against me, even though the plan sounds good. So when you look at stocks, I like to look at management and say, okay, what's management thing? Right? Okay, this one I want to do, right? Now I'm looking, I'm like, all right, well, what do analysts think? What do other people think? I'm watching the volume, different things, right? Not to get too advanced, but it's my belief in their execution. That leads me to different companies. And sometimes I hang my hat on the fact that I believe in the plan. I believe in 5 years they'll be different, and I believe they're in a transformative phase. And that will be me putting money in the market to work and letting it sit and let it do what it's going to do.
Nice. So I got a question for you. We got a question from the audience, and this is the perfect segue to get this in there, right?
Yeah.
So typically when you're scouting a company, how long do you watch it before you actually invest in it? So if you add something to your watch list, how long are you monitoring it before you actually put some money into it?
Two things, right? So it's not really a time frame on there. It's going to be how much liquid do I have, right? My liquid or all my investments tied up. That's the first thing. Then the second thing is my price range. Where do I feel comfortable buying the name? And when I look at the name, what's the price range on it? For example, let's say Walmart, right? And we had the conversation. And I'm like, all right, I saw Walmart. I did my analysis. I watched it. I identified it at 139. I watched it go to 141. And I'm like, okay, my range is somewhere between 141 and 150. I feel comfortable because I feel like there's a lot of room for it to run. But I bought early because I wanted to be ahead of the wave because I was really confident in the research that I did in the company. So sometimes it could sit there because I don't have bread to put in the company. Or sometimes, like, for example, with the industrials plays we talk about, I'm like, listen, I'm looking at it now. I'm not investing now. I'm looking because I know the money's going to come at some point in time. I don't need to invest there yet. We haven't pivoted there to the point where we're going to get a stimulus package yet. We don't have a date or any kind of thing like that. So I can look at the industrials with a lot keener of an eye now and not do anything. So it all comes down to where the money's going. Like, I always follow the money. Where's the money at right now? And if there's an opportunity to swoop in, I will swoop in. But there's no time frame. It's just based on my idea of, okay, what's the price range I want to buy at? Okay. And then, how I see the company moving over the course of time.
Dope. I love that. Okay. All right. So we went through that question. Now I feel like you've done this before. But just for anybody new, if you can just give them a quick breakdown of like, what are some key fundamentals that you look for when you analyze a company? That was another question that we got. And then after that, we're going to go to a little bit of just some portfolio management stuff. I think those questions we got. Yep.
All right, so I mean, this stuff is like readily available. If you go to sec.com or .org, whatever it is, if you go to the actual company's investor relations page, so you have the 10K you can look at, which is the business line stuff, and it's going to give you an idea of what they're doing. And a lot of times, I like the 10K because when you look at it, sometimes you'll be surprised.
Okay.
And you have an idea of a company, and when it lays it out what the company is, you go, oh, I didn't know they did that, or I didn't know they made money off of this, or I didn't know that was a competitor. So it gives you an identity. I like to look at balance sheets, obviously, from a financial standpoint, how much money they make, how much debt they have, EBITDA. I like to look at the, our earnings per share, forward earnings, stuff like that to give me an indicator of where they at, like where they're trading. For example, let's say, when you invested in Apple in March, they were trading at 19 times earnings, relatively cheap, right? And then when we got a pullback and after the split, they're trading at 29 times earnings, a little bit more expensive, but you have to look at that to give you an idea of where it's going to trade, because when I'm going to buy it, I need to have an expectation on where it's going to go. And so sometimes when I'm buying, if I'm going to look at those kind of things. I'm going to check, again, analyst stuff. So you have like bar chart, which is a good one for free, that people can check to get some sentiment on what analysts think and different things, right? I'm looking at the 52-week high. Where's it trading to that, right? Is it trading within 10% of the 52-week high? Is it 20% out, 15% out? So I'm putting together a list of different things because everything's not the same. All companies don't trade the same. And sometimes, like, if you stick by these rules, it doesn't make any sense. Like, if you look at Amazon, they're trading at like some whatever times earnings. Like, technically, you're not supposed to buy them because they're trading. Right? But who's not going to buy Amazon? So you kind of have to make the rules as you go, as you learn the company. Again, some of the stuff isn't going to be so much of numbers driven as it is going to be idea creation, right? Idea generation to see, okay, they have this plan. Can they execute it over a period of time, on top of the fact that they're trading at a cheaper value, on top of the fact they have great revenue, they have strong balance sheets, right? I look at the earnings reports from the last couple of quarters and see where they came in at, as far as EPS, as far as rev, as far as what they have on their sheet. So that's going to be it. I'm going to look at their competitors, right? I want to see where they rank. So again, back to McDonald's. I want to see where McDonald's is in comparison to Darden Food Groups, in comparison to Wendy's, in comparison to Domino's, in comparison to Chipotle. I want to know where you sit at as far as where you're at in your competition matrix, let's say. Right. So there's going to be a list of things that I'm going to look at. I'm going to look at management. Like, who's your CEO? Who's your CFO? Who's your CEO? Are they new to the space, right? The one reason why I love Chipotle is because they took the CEO from Taco Bell, who reinvented Taco Bell, right? Taco Bell was trash for a while. We have to be honest. I know people like it, but it was trash for a good like 5 years. The guy made it popping, right? And when Chipotle was like $300 a share, it was never a business thing. They got a bad batch of work. They got a bad batch of food, and people got sick 2 or 3 times, stock tanked. They went and got the CEO from a rival brand who's great at rebuilding images and who embraces technology. Gone. It wasn't a business thing, that was a coach thing. It wasn't a team talent thing. So that's not a fun. That's a management. Who's your management? Who is the guy at the head of the ship on top of the other numbers to cement how I look at the company or how I look at the name in comparisons to its peers?
Nah, I love that. Okay, so to that, right? So you named a couple of tools, and I wanted to get in that because somebody asked the question of, did you have any different, because you are on the institutional side, were there any different type of tools or access that you had that maybe a retail investor doesn't have? And I'm pretty sure you guys got some stuff, but I don't know.
It's again, like, you get to be in a room and hear certain conversations, and you get to understand what they're doing. And a lot of times people don't realize too, like, there's more than just stock at risk, right? There's preferred shares, there's options, there's a whole bunch of other things that prop the stock up, that keep support levels, and that the average person doesn't get to see. So, you have these varying desks that are doing business. So, if our derivatives desk is doing business, that's a whole nother kind of business that's keeping that stock propped up, right? Because even though you're not trading stock, you kind of are, because those secondary investments are what keep those support levels. Because if it does hit a certain level, those things kick in, like those trap doors. That's what keeps kind of like stocks at certain levels. Or that's the same thing that can make a stock plummet if there's bad sentiment, where the trap door just makes it fall even further down than where it should be.
Right.
So yeah, you have certain tools and idea around certain stuff or certain conversations, or you're able to actually talk to the management, right? And
Right.
it's different. You get an idea of what they think. So yeah, there is a little cheat code.
If there's a way, is there a way that retail investors can avoid those trap doors, or what can a retail investor do to kind of get some type of insight to it? I mean, I know we have access to guys like you and Mark, and you guys are kind of like that bridge, but if somebody wanted to like get on a site or something like that, is there anything out there?
Bloomberg has like a paid platform.
Okay.
That's something of that level. But it goes back to, like I always say, your information diet, right? Like what you digest as far as what information that are you reading, where are you reading, how are you reading, when are you reading, what your habituals are as far as relative to your opinion to the market. Because at the end of the day, some stuff is as clear as day. Like a lot of the stuff that people say institutions have, they're more granular, but it's for a reason, because they're chopping a larger piece of the tree off.
Right.
As a retail investor, you should be happy with the leaves, right? Like the leaves I'm happy with that, because that's not the whole tree. Let the institutions, like I said before, it's an ocean, right? And you have to know who you are. The institutions are whales, right? And hedge funds are sharks. Be a fish. Just get out their way. Ride the momentum. Like when the whale comes through, ride the momentum behind the whale, but just don't be in its way, because that's a quick way to, get yourself out of here. But there's no way. It's just understanding your placement in the company, understanding why a company trades the way it trades. Right? I think that a lot of times people don't necessarily understand why a company trades, because what happens is you get to the market and you see all these stocks. And you're like, oh my God, like I want to buy Apple, I want to buy Microsoft, I want to buy Tesla, I want to buy Facebook, I want to buy Zoom.
Yes.
And you get on information overload.
Yep.
And now you don't know what to do, and you're like, I don't know, and I want to buy this. This is going to Peloton went up. I want to buy DraftKings. And the idea of it is that to stick to your plan. So when you come in, you have a plan.
Mm-hmm.
Right? What your plan is as far as what you want to invest in, how you want to invest, how you want to build.
Mm-hmm. They're
going to make money. It's a cycle. Everybody's going to make money. It's money around all the time.
Right.
You cannot be distracted by money. You have to stick to your plan. Now you can change your plan as you go, but the main course is I have a plan. I have an identity as an investor. What's your identity? How do you game? What's your risk tolerance?
Mm-hmm.
That's good.
No, go ahead.
No, that's gonna tell you a lot about yourself. If you have a high risk tolerance, what you're looking at is not gonna be the same as somebody who's a value investor. They're looking for value, so they're not gonna be sourcing the same thing that you're looking at. Doesn't make either one of you wrong. Doesn't make either one of you right. But you have to understand your identity. I think a lot of times people don't have an identity. They see a person and they attach themselves to that identity.
Mm-hmm.
An institution or a person has a lot of money, they can take a lot more opportunity risk. And like I said, the vending machine drink, right? It's like you go to the vending machine and you're hungry and something costs $1. Like whatever, if I don't like it, I'll throw it out. It's $1. If that same item costs $5 or $10, that's a longer conversation. You start Googling what's the ingredients.
Right.
But opportunity value. Sometimes people kind of give people with money too much respect to a certain point. Say, okay, you got money, you're smart. No. You said opportunity cost. Like you just have enough money to take risks that somebody else who doesn't. So you have to trade a certain way when you begin, because you need to be as sharp as possible. So then when you get to that level, that's when you surpass them. So the thing about somebody who's stupid with money is going to be stupid regardless. If you can be intelligent and work your bag, and your bag gets bigger, when y'all get to the kind of equal platform, I'm going to go right by you because my precision and my execution is better than yours.
You killed it right there. And just to follow up on that, right? I think that is exactly why I wanted to start what we talked about with money, basic money management, and understanding how to manage your money. Because if you can't handle or manage $1,000 right now, when you get that bag, you're not gonna know what to do with it. You're not gonna know what to do with it. So
also you gotta
have those skills now. So when you get more money, you know what to do with it.
I think, like I said, it's our culture has a fascination with it, right? It's a fascination with money that other cultures may not have, and it's also understanding like supply and demand, right?
Mm-hmm.
Right. Money is just paper. If I rip it up, it doesn't exist.
Mm-hmm.
And so if I pull up the Forbes top 400 richest people in the world, they all own a commodity. Whether it's an intellectual commodity, a physical commodity, they own some form of commodity. Why? Because there's supply and demand attached to that commodity.
Mm.
And if I have a glass of water in a room of 100 people and I pour half of it out, did it become more valuable or less valuable?
It's going to be more valuable.
Right? But like at the end of the day, the money that you give me gets more significant. I give you less water.
Yeah.
I give you less water for more money. Like at the end of the day, it's the fucking demand.
Right.
And so when you turn off that fascination with money and say, all right, I'm out here, like for me, knowledge is the commodity that I'm mining, right? And the conversations that I have is me growing that commodity. The smarter I get, the bigger that commodity gets, the more value that's attached to that commodity. So I can demand more money, right? Demand my worth, so to speak. So I don't necessarily, we all love money, but I don't care about the money as much as I care about the knowledge, because the knowledge is going to make me money. If I give you $1 million with no knowledge and you give me $1 with knowledge, I'm going to catch you. I'm going to pass you because you don't have any knowledge. You have to now go look for it. You got to spend time looking for it. If I'm precision what I'm doing, I'm going to catch you because of how I view things, and I'm able to make deals and trades and not be emotional. Money's not emotional.
That's gems right there. Yeah, you're right.
I've never had a bill collector ask me, Q, is this drug money? Like Verizon never asked me, yo, be real with me. This money comes from selling drugs. Like they don't care. The equation don't matter. It is this lump sum. Yo, you owe a bill. Give us our money. Apple has never stopped you in the store. Hey man, hey, is this real money? Hey, did you work for this? They gladly take that swipe and keep it pushing. So you cannot attach yourself to dollars. You have to attach yourself to commodities, because commodities are where the value's at.
I hope y'all caught that. Don't attach yourself to money. Attach yourself to commodities. That's real. All right. So let's transition. We're gonna get into some questions. So we got some questions in the chat, but then I got a few questions that came through my Instagram. So I'm gonna go through those first, and then I'm gonna try to see if I can scroll through the chat, because I had a few people throw some questions in there. So from my guy Jerry, he asked a really good question, and this is one me and you kind of chatted about, which is how much of your portfolio should you keep in cash?
It depends how much money you have.
I thought the same thing, right? And we talked about this, but I'll let you go ahead and speak to it a little bit as to why you think it depends.
So for me, like, all right, if let's say I have $10,000 in the bank, I don't need $10,000 staring at me. I try to put as many dollars to work as possible, because again, put them in the market, put them to work, you're going to make a lot more money. The market's cycle. So stocks can only do two things: go up or go down. There's no, there's no sideways. It's up or down. So for me, what I've learned is there's no need for me to have a lump sum of money sitting in my bank account when I can put it into things that are going to spit out 15, 20%, 10%, whatever it's going to be. So I'm not a big proponent of sitting on a large sum of my bank account. I'm a big proponent of putting that money to work to allocate places where you feel comfortable. Again, it's your recipe. So if you feel comfortable putting $20,000 in a QQQ because the NASDAQ 100 has a bunch of good names, do that. You feel good about VGT, you feel good about XLY, whatever you feel good about, put your money to work, because you're going to make more money in the long term than you are going to let sit in the bank. So I'm not a big proponent of like, hey man, sit in cash. For what? What am I sitting in cash for? Like, I don't understand, you know what I mean, what the premise is.
I do. So
unless you have millions of dollars, but it's like, all right, I could sit, right? But for the most part, as retail investors, a lot of times you don't have the luxury of sitting in cash. Somebody with $1 million does, because they're waiting for the next idea. But for the most part, put your money to work. That way you're getting the best returns and you're building your portfolio. And it's making you smarter.
Yeah. No, I agree. Because so what I was going to add to that, and then just to see if you kind of agree with this, is that typically when people ask me that question as well, it's a very big dependency, right? Because it depends on how much money you have in your portfolio. So here's what I would ask you. Let's say if we had to set a range, right? Let's say if you're working with a portfolio of from 0 all the way up to 25K.
Yeah.
And then from say 25K, you have to 100K, and then we got 100K plus.
Okay.
If you just said those three ranges, what would you give it a rough estimate of?
The only person that should have a cash allocation is to do with 100K plus. Everybody else should be, because like, when you look at our market today is not the market of the 80s or the 90s. So when you look at like ETFs, right? They're a big proponent because you're getting secular, either value-weighted or market-weighted ETFs that are able to get access to companies you may not be able to afford. And so I feel a lot more comfortable with taking my money and putting it in there because, one, I'm creating a mini index, right? So for somebody who's, let's say I have 5K, I have 5K and I bought XLY. Let's say because it's hot, right? We talk about today.
Mm-hmm.
I buy XLY. I have access to Amazon, Home Depot, Nike, Starbucks, Dollar General, Bookings, Target, General Motors, Chipotle. I have access to all those companies, right? I would own all those. I think Lowe's, right? I would own most of those companies outright.
You gotta add Tesla soon.
Exactly, right? Boom. So, again, so I'm hoping to add Tesla and move Chipotle up. If they give me Amazon, Tesla, Chipotle is over. That's another conversation.
Y'all caught that.
Yeah. But so when I look at that portfolio, I would own those names. And when I pull up the holdings in the portfolio, if I'm new to it, I now have an index I can watch so that when I get my money up, I can buy that stock because I'm betting on that portfolio to win, right? So I'm already vested in that portfolio winning. I can now zoom in and say, okay, I want to buy one. I want to buy Nike, right? I can buy Nike as a portfolio. I've now purchased Nike and I own the portfolio. I'm betting on that to win. Why? Because somebody who's a lot more intelligent than me put that together and they didn't get paid to lose money.
Correct.
They get paid to make money. So I'm going to leverage the fact that they've given me this cheat sheet. I'm brand new. And I can look at this index of 100. It could be 70-something names. It could be, 150 names. But I have a small index. That way I'm not overwhelmed. And now I have my position there. Now I can move on because now I have profits. And now if you want to go gamble your profits, that's fine because that wasn't your money anyway. You made that money, but it's not attached to your base investment. So from a standpoint, if you have 100K plus, then you can be sitting there for your next idea. But anything under, why would you not be invested, right? Not to say you should be investing reckless, but why wouldn't you be in the market?
Right, making your money work for you. Nah, that's great. So for all y'all out there, if your portfolio ain't at 100K, you should not, very limited cash. Let's keep it down.
If you think about this, like, what are you waiting for? Like,
right, it's like, what are you waiting for?
Like, if I purchased, let's say Costco, for example, if I purchased Costco at 360, not 370, right? If I purchased that at 370 at 10 shares, let's just say, and I waited and I purchased it at 360, I save $100. Like, right. You know what I'm saying? Like, it's not like you're especially not trading in the long run. Yeah, like you're not trading, like you're not really. What are you gonna do with that? Like $100. Now, if you had 100,000, that's a different conversation because that adds up over time. But when you're first time investor, I want to be attached to something that's quality because again, it buys me time to do research and it introduces me to how a company should be run. That's another thing. If I buy Apple and my standard is Apple as far as how a company should be run, I'm gonna look at a lot of other companies differently. And I'm gonna say, you know what I mean? It ain't Ralphville. Like, I like them, but it's not the same. But when you start looking at management and you hold management accountable, because that's ultimately who makes the decisions for the business lines and how they do their business and how they present things and what they do. When you hold them accountable, you start to understand, okay, I like Apple, I like Microsoft, I like this management, I like this. And you start to, what a good company looks like. I don't understand how you could start investing and then you invest in like a hyper volatile company. You don't know what a good company looks like. So how do you know? A good company can come right across your face, and you're like, I don't know what it looks like. You never started there. So you have to start with great companies so you can understand what a great company. And that's how you catch a company at 20 that goes to 100 because you've identified great management, great business line, good future, and they're going to hit earnings next 3 or 4 quarters. And that's when the stock goes here. But you have to identify that beforehand. So if I jump in a Nikola that has terrible management and it's all speculation, you learn nothing. All you do is make a little bit of money or you lost a little bit of money and you come out the other side of it with no real return on investment as far as knowledge capital.
Correct. That was game, and I'm going to definitely have to run that back because you gave 4 key points. I don't know if y'all caught all 4, but you definitely going to have to rewind that to make sure y'all caught all 4 of those. Definitely. And then the other thing that I wanted to run back that I thought you said that was really dope, that I think people who are new to the market could really use is you said when you look at the top holdings of an ETF, it's like a cheat sheet.
Yeah. I
always tell people when it comes to this investing thing, this is an open notebook test.
Yeah.
You do not have to learn or memorize any of this stuff by heart. Like people who like to read charts and stuff like that. Like I'm not about to memorize every single technical pattern when there's cheat sheets everywhere and I could just go pull one up and look. You know what I mean? So I think the fact that you said that is very key, and that people should, definitely catch on to that, Jim. So going back to the questions, so people want to get a little insight to what you're going to be looking into for 2021. So the first question, and before we get into like what you're looking at for 2021, it was a question about what sectors do better in which part of the year. So general centered around seasonality. So they asked, what sectors tend to do better in which part of the year?
I mean, it's relative. Obviously, consumer discretionary around this time of year is going to kill. Holidays coming up, back to school stuff. So, consumer discretionary from September through January is always a nice play. The obvious characters are always good because people are spending money, right? Mm-hmm. And you start looking at like summertime, you might look at like airlines and stuff like that, cruise lines, people going on vacation. I think it lays it out in front of you. When you start looking at the timeline, okay, so we start in the fall, and you say, okay, consumer discretionaries are going to do well. If you even in pockets before COVID, airlines would do well for the holidays, right? Because people are traveling, Thanksgiving, Christmas, New Year's. So look at those areas, and it depends, right? Like look at the beginning of the year. A lot of times we're gonna look at like financials at the time. It depends on how they're trading. Industrials, if we get new stimulus bills and different things of that nature. So each part of the year is going to be different, but it's usually outlined, right? Summertime, you want to be cruise lines, you like airlines. If that's what you want to trade on a secular kind of win,
right?
Go that route. Hotels, right? People are going to be going on family vacations and whatnot. But I think it's hard to trade that way because some of the trends are going to change, and what the environment we have now is definitely going to be a lot different. So you can't even hang your hat on knowing what's going to happen next. Like I know certain sectors are going to do well, but I don't know how well they're going to do. We're still kind of finding out right now in kind of the new world, so to speak.
Right. Okay. Now, with seasonality, the people want to know, are there specific sectors or stocks that you're looking at for 2021? And for any of those who may not heard Q speak before, we definitely know he's looking at the industrials, but I'll definitely let him speak more to it. But is there any others for 2021 that you're looking at?
I mean, like I said, obvious characters, and like, don't quote me. What's the saying? What's the joint? I don't know, like the little joint. Consult your financial advisor. What's that?
We definitely put the disclaimer out there.
Whatever that disclaimer is, yo, do not listen. This is me just telling you what I like. Do not go buy nothing. Don't try to sue me. Yo, you said buy this. No, I didn't. Don't take me to court. Like this time of year, right? Walmart, Costco, Target. Companies that are on both sides of the trade. And when I say that, I mean like, if we get an outbreak, they're going to make money. If we don't get an outbreak, they're going to make money. And those are going to be the slow drip companies that hit singles, that hit doubles. So this time of year right now, I like consumer discretionary for the obvious reason that we're going to spend money, right? And I also like it because it's a holiday. So that brings a tailwind into a stimulus package. So it's like, all right, you have a holiday that you're going to spend money on, and then you're going to walk right into a stimulus package where people are going to get money, access to capital, and they're going to give right back. Right. So I like that area. I like Dollar General. I like Starbucks, McDonald's. I like a lot of consumer. I think consumer discretionary will outpace tech next year. I think Mark's the same thing because people have money, right? And people, again, we've been locked up inside the house. There's going to be a lot more travel, a lot more just discretionary spending as far as once everything gets through. So for me, I like that area and I like the momentum it brings. So I've been readily in it. I'm probably about 5-6 weeks out. Like I said, Costco, Walmart, Target, Dollar General, Home Depot, Nike, Starbucks. I mean, like the obvious people like that are going to make money, and that they've made money through a pandemic. So what are they going to do when the pandemic's over? My next pivot to that, again, I talk about pivots, is industrials. Why? We're getting a stimulus bill. So at some point in time, we're going to have a new president, right? We're going to have a new regime come in office. And the best way for them to leave a legacy is infrastructure.
Yes.
That's the best way, right? People will leave statues and monuments and stuff like that. That's infrastructure. They leave a presence. So they have to fix roads and airports and bridges. I think we have over 70 bridges that need to be fixed. So you have a lot of opportunity in an industrial space. It's just figuring out how much money they're going to get and then where that money's going. So I like industrials because I can watch it right now and kind of pinpoint what I like. Like I said, I like XPO. A firm.
You mentioned that one a few times.
Yeah, I don't know.
Y'all better make sure y'all add that to your watch list. I feel like in 2-3 years you're gonna come back.
I gave Cass XPO at 99. I think it's like 106, something like that now.
Yeah, it definitely
You know what I mean? Road, same thing. Road does paving. Like when you look at Road, it's not sexy, but it's a company that if they start fixing airports, which they're going to have to, if they start fixing highways and different roads that are going to make money. So I'm looking at pivot points, right? So I'm looking at consumer discretionary through the holidays to pivot into industrials in the spring, because now we'll have a bill and we'll have money that's going to go into industrials and into infrastructure. And I'm looking to pivot. And then from there, I have another pivot point that I'm looking to pivot. So I'm always knowing what I'm going to do with the money I'm going to make. So right, those two, I like. Obviously, tech is obvious, right? That's the most scalable business. I like tech. You know what I mean? You should be in tech in some facet or not. And I look for companies that are scaled towards tech. So a lot of the companies I like to pick in consumer discretionary or industrials have a open exposure or open scalability to technology, like Nike, right? They have two different apps, direct to consumer. They've merged on the app. Chipotle, great loyalty program. Direct to consumer, Chipotlanes. They have a lot of stuff as far as technology, right? McDonald's, same thing. McDonald's is now just getting that kind of technology spend. So I want to attach myself to those kind of companies because they're scaling out to technology the same way that I want to be in industrials that have technology. XPO, probably the differentiator for them is technology, if that makes sense.
No, that makes perfect sense. I mean, it goes to kind of like what Mark has told us. Once technology, merges itself into a sector or industry, it's like it's glued, it's stuck, it's not going nowhere. So the faster these businesses can introduce technology and bring that into their business model, it's just going to make them a more powerful business. I mean, like I said, look at Chipotle, they're killing it. Okay, let's see. I'm trying to make sure that I get through all the questions here. So let me see. Let's go through the chat. Yo, this chat been killing me, man. If I was making smirks, yo, they was going in on the chat. So one of the questions from the chat is, where was it at? It was a good question. Somebody wanted me to ask you, where was it at? Give me 1 second, let me find that. Oh, okay, there it goes. It goes, so how many how many stocks or ETFs do you invest in at one time?
Depends on much capital.
How many do you hold on in a portfolio?
So it just depends on your capital, like how you layer things. Like I made it known I like the satellite strategy of taking an ETF and then buying some of the holdings in that ETF in the actual stock, and so you'll get some overlay. So I mean, you could go like for me, I try to go ETF stock, right? I try to kind of mirror that, and sometimes you get some overlap, right? So if I own, say I own Tesla and I own QQQ, right? I'm getting some exposure there, and I'm also getting exposure from the stock. Same thing if I own Microsoft and Apple and I own QQQ. But if I own that, right, I might still own XLK, or I still might own VGT, where Apple and Microsoft are still the top two holdings. So sometimes the ETF purchase is more for exposure to names that you may not be able to afford. So, for example, VGT has PayPal, Square, I want to say a couple of payments, Visa, MasterCard in it. So it's like, all right, if I didn't want to own one of those, or I couldn't afford to own one of those, I can own VGT and get exposure to those four. Now, obviously, the portfolio is bigger than those four names, but I'm getting some broader exposure to the payments without having to own the name. And then I'm getting Microsoft and Apple at the top of the portfolio, mixing like NVIDIA and other great names that I would want to own myself. So a lot of times I like to go stock, ETF to mirror it, but there's no wrong way to do it. It's more so how much money do you have? Because some of these things are pricey. So it's like, all right, I can't afford that. So if you can't afford some of the premium stuff, you have to figure out, okay, what can I afford? And look in the portfolio. Like XLK trade where VGT is a $327 or $28. So again, you're getting more names in VGT, but maybe some of the core holdings you don't even want over there. So don't look over there if what you want is an XLK, because maybe some of the core holdings there make more sense for you. But you have to kind of look at it and kind of go back and forth on it to figure out, okay, what do I want to own? Why do I want to own it? How long am I going to own it for? And then how am I pairing with a stock? Like I'm not owning ETF that I don't want to own stock in the holdings. That is making sense. I'm betting against myself.
Mm-hmm. So what's the most positions you will have in a portfolio?
Probably 5 and 5.
5 and 5. Okay.
5 and 5. I think like a lot of times it gives you opportunity to own different things. So again, you're gonna get overlap. Like QQQ, though it is the NASDAQ 100, super tech heavy. So if I do like VGT, I'm gonna get some of the same names, and so you get that overlay. Again, XLY, I like for that reason, because there's a lot of consumer discretionaries that I like that are affordable. So again, I'm looking to source. So I try to go with like 2 tech, I say a consumer discretionary, a healthcare, and probably a wild card. Sometimes it could be industrial, it could be financial, it could be something undervalued. So I try to stick to where the money's going. So it just depends on the time of year and depends what we're doing in the market.
Bet. Okay. And then on top of that, the person is asking me how many accounts should we maintain?
All right. So I'm not considered a regular person, so I only can have certain accounts in certain places. So that's not for me. That's more of a personal choice. You can have if you want. Like, I can't. My accounts are watched and stuff, so I'm under the eye of Big Brother. And so it just depends. Now, if you want to trade options in one account and then trade stock in another account, or if you want to say, okay, this is my ETF account and this is my stock account, you can do that and separate the two. Doesn't make a difference. It's more personal preference.
Got it. Okay. So just to add on to that, what I can say I know is that when it comes to accounts, I mean, my wife has her 401k. We each have rollover IRAs, and then we just have a brokerage. Well, actually, we have 2 brokerages. One that I do options out of, and then one that's another long-term portfolio. So if that's helpful, yeah, we got about 6 accounts. But it's because I don't want to commingle my funds. Like each account has a purpose. So that's the reason why we got so many. Sure. Okay, let's see. They said, let's see. Okay, so one of the questions was, are those holdings stocks or options?
So again, I don't have the regular rules, so I'm not allowed to day trade. I'm not allowed to do a lot of stuff. So if I buy a stock, I have to hold it for 30 days minimum. I can't swing trade. I can't do a lot of different things based on my profession and the rules. So a lot of stuff that I focus on is going to be long-term investing. The only thing I can kind of trade is like ETFs, but that's not really something that you should be trading like stock. It's weird if you do that. Some people do. It's not my thing. Like I just got clearance to do like options on a couple different things. So
you're gonna be looking to make some plays.
We're gonna see what happens in 2021. But like for the most part, I focus on I focus on long term because again, like long term, the compound interest that you're gonna make over the long term investing in a good company, you're gonna be just fine. And correct. You always have time to options trade. And again, people always look at the reward and never the risk. And so a lot of times, like you have to go into a trade thinking, okay, what's the worst case scenario? What's the best case scenario? That's also why I attach myself to premium things, because the worst case scenario is never as scary as it is for something like options trading if I don't know what I'm doing. So right. you hit on the options trade, now you're an options guru, and you start doing 2-week calls and 2-week push and that account goes from $50,000 to $5 real quick on the way of it, and you're gonna learn a hard lesson doing that. And so for me, I go with let me build my base, and that way I can take some of my profits and I can play the options. If I lose, I lose. But for me, it's still gonna be a learning experience because it's not something I readily do all the time. And so it's something where it's an adventure, so I can take adventure money and go do adventure things, not take my actual capital that I'm putting to work and like gamble it because I don't necessarily know what I'm doing, let's say.
Dope. So it looks like we about to have Q join the dark side on this journey, these leap option journeys.
We're gonna find out, man. I hear a lot of chatter on that side. I'm not gonna front. A lot of guys, I see a lot of people posting stuff, and I'm kind of curious to know what that's like. So definitely gonna try my hand at it. I don't have a history of doing it. It's not something that I particularly do all the time. But like I said, I like to do things like that with the capital that I don't really count on, because then, again, if I lose, it's not a hard loss where it's like, damn, I lost my principal to my investment. So now I have to make that back. It's like, all right, well, I made a nice little profit here. Let me take that and try my hand out at it, and I can get better over time. And again, like the cost, right? How much money does it cost you if you pick a bad long-term stock versus a bad option?
Well, with that stock, you got time to hold it and bounce back. That option,
the thing about stocks is you never take a loss or a gain until you what?
Until you sell. Look, listen, you don't take an L until you sell.
The thing about long term is I could be wrong in the first 2 years, be right in year 3.
Yeah, you're right. You're definitely right.
There's a level of patience that comes with it. And again, when you're buying with conviction. When I purchase a name, I mean, me and you have talked, and I've talked about names. There's conviction in my voice when I say the name because I believe in it. Now, my thesis can change over time based on information that's given to me or that I find out over a period of time, but it's my thesis. I want to live and die on my strategy. So when I look at that, I have conviction in the buy to know, okay, I'm in this name and I don't care about the headwinds, right? I don't care about the bad publicity. I don't care about articles. I don't care about nothing. I know that my strategy and my thesis are correct for what I have right now, and in the long, I'll be fine.
Got it. Dope. Love that. And if anything, that was bad news. That's just opportunities to add more.
Yeah, when you believe in the company, I never understand why people want to buy on green days. Cass will hit me like, yo, should I buy today? Why you want to buy at the highest price? Yo, when red days come and the market's down 900, 800 points, that's when Gucci is on sale for $100. That's when you're in the market and I'm buying names. I mean, you're grabbing names in 5 years. You're going to be more mad that you didn't buy more than now, right? Because, again, you have to go back to buying with conviction. A lot of times people don't buy with conviction.
Got it. Dope. No, I think that was a beautiful gem that you dropped on the people. So before we wrap it up, we're at the 9:35 spot. We went a little over, which is cool. But what I would like to do is if there was one tip or one thing of a piece of advice that you would give to other first generational wealth builders out there, what would it be and why?
The first thing that pops in my mind is enjoy the journey as much as you enjoy the destination. And so I say that because a lot of times we live in a society that people never enjoy the journey. They're so busy and focused on getting to the destination that the gems are in the journey. All right. And if the journey isn't enjoyable, the destination is going to be heaven. And so like about people flying, right? It's cast out like, oh, I'm going to go to Miami this weekend. They'll hop on the $49 flight. They'll sit like this, but not for 3.5 hours. They'll stay at the top of Biscayne. They'll drive down the columns, take 4 pictures, throw in the gram, and make it seem like they had a great time. But you're rushing to get there can tell me that you didn't enjoy the journey. So it's very rare that you're going to enjoy the destination if you didn't enjoy the journey. So again, long-term investing, short-term investing, swing trading, however you're going to slice it, it's a journey. You have to enjoy it to pick up those gems. You can't be in a rush to go nowhere. And so for people that are brand new to this space, be patient with yourself, be patient with the process. Understand that you are going to lose. I'm not right all the time. I take victory laps when I'm right, but I'm not 100%. Nobody shoots 100%. And that's why your thesis is important, right? So again, your journey. So my thesis is so important because now I can go back to that and figure out where I was wrong. And maybe I was right. Maybe the market didn't react the way I thought it would, but I can go back to the notes and figure out what I could have done different for a different outcome or what I didn't see. And again, that's all part of the journey. So the one thing I've adopted is, I love the journey as much as I love the destination. And I know when I get to where I want to go, it's going to mean more because I had a meaningful time getting there.
Dope. I love that, man. I love it. And before we get out, man, Q, for the people out there, where can they find you? Where can they tap in? Where can they connect with you, brother?
If you don't catch me on Clubhouse, that's not for everybody. No disrespect, no shade. IG, Mr. Wall Street. I'm really only on IG. Mr. Wall Street, you can holler at me, and or you catch me. Some cats be hitting me on LinkedIn. I respect y'all. That's a grind. The cats really, you type my full name and then catch me on LinkedIn.
I need to add you on LinkedIn too.
Yeah, I respect the cats that hit me on LinkedIn. That's a different kind of grind. But IG, Mr. Wall Street. And I don't even know how I spelled it. I gotta check.
I think you have it. It's MISTER _, and then it's like Wall Street.
Yeah, so.
Oh yeah.
I'm always down to answer questions. Help people. If you're down to help yourself, so that's I'm here for the culture. The conversation isn't about me; it's about me being able to reach back and pull forward. Because we need that more. And the more that we've been in this pandemic, the more I realize that people have listened to my voice, and my voice is kind of needed around. And
yeah, man, you one of the giants, man. We need you.
Listen, man, I'm just happy to add to the combo. So I just be happy to have conversations with people of color about these kind of things because for a long time I wasn't able to. So for me, it's always a pleasure to lock in and tap in and have good conversations and be able to help my people.
Dope. Well, look, man, I appreciate you for jumping on and doing this live with me, man. This is a heck of a, I was about to say the H word, but it was a heck of a way for me to kick off my season 2 Again, like I said, I appreciate you, bro. You already know I hit you up and ask you a lot of questions. So,
you already know. I appreciate you just bringing me on and thinking highly enough of me to give me the platform just to speak. So, like I said, it's always a pleasure and it's always humbling just to be around people who respect you at that level.
Listen, bro, you helping me do numbers, man. My first live, I think we hit 342, man. We almost had about 500 people on this first live. So you helping me do numbers. So I appreciate it, man. But to everybody that's on the tube, man, I appreciate everybody that tuned in. Like I said, Q, I appreciate you, brother. Y'all make sure y'all reach out to this brother, man, whether it's on Clubhouse or IG. Just a wealth of knowledge. I know I usually pick his brain, so you guys definitely should be doing the same. And with that, guys, I'm definitely gonna have some more guests. And Q, we got to do this again, man. I would love to have you come on. We can definitely do like maybe a 2021 check-in or something like that.
Definitely. You know, I'm always here, man. I'm always here for this.
My guy. Well, hey, look, man, you have a good evening, man. I know you about to watch the draft because I know you a big basketball. Who they draft? Who was number one? Quick draft update.
It's a lot going on right now. Rubio got traded back to the Wolves. A lot of trades, a lot of stuff going on. So I'm about to catch up on that now.
Bet. Well, I ain't gonna hold you up, man. Have a great evening. Everybody on tube, man. Y'all have a good evening, and I appreciate y'all.
My brother, you be easy.
All right, man. Have a good one.